U.S. commercial revenue guided to grow 115%, and the Rule of 40 metric hitting an astonishing 127%. Palantir's fiscal 2026 outlook isn't just flexing muscle, it's redefining the upper limits of what a software company can achieve, but at 125 times forward earnings. Is this the ultimate money printing machine of the AI era, or a valuation bubble that leaves absolutely no room for error? Hey everyone, welcome to Stock Market Breakdown. Management just issued bold guidance that when you look at customer growth and the rising backlog, the foundation looks solid. Today, I'll break down how AIP is becoming the operating system of the enterprise, and at 1 to 5x earnings, what truly supports Palantir's premium valuation. Palantir's management has issued guidance for 115% revenue growth in its U.S. commercial segment for 2026, and let's be clear, this isn't some overly optimistic analyst projection. This is official company guidance, considering that fourth quarter growth in this segment actually exceeded that number. The market views this outlook as both ambitious and highly achievable. U.S. commercial has now fully overtaken government contracts as the core growth engine, driving Palantir's second valuation expansion cycle in software. Doubling revenue typically happens in the early startup phase, but Palantir is already a $100 billion company and still delivering this kind of acceleration that tells you commercialization has entered full harvest mode. Corporate America's anxiety around AI is turning directly into signed contracts for Palantir. The gold standard for evaluating a software company is the Rule of 40 revenue growth plus profit margin. Normally, anything above 40% is considered elite. Palantir just posted an astonishing 127%. That number doesn't just exceed industry norms, it shatters them. It means Palantir is sustaining hypergrowth while maintaining extraordinary profitability. This performance clearly separates it from the average SaaS player. A 127% Rule of 40 is basically a physics-defying moment in the software world. It tells us Palantir has moved beyond the burn cash for growth phase. Every dollar invested is generating multiples in return. The kind of operational efficiency suggests a highly standardized product with powerful scale effects built in. The core engine behind this growth is AI's artificial intelligence platform. It's no longer just a tool. It's evolving into an enterprise AI operating system, deeply embedded in supply chains, logistics, and mission-critical workflows. U.S. commercial customer count rose 49% year-over-year to 571 clients. Even more striking, remaining deal value, essentially backlog, surged 145% to $4.38 billion. That backlog represents future revenue already written into contracts, a reservoir of profitability waiting to be realized. We need to see AIP for what it is. It solves the last mile of AI deployment for large enterprises. That $4.38 billion backlog is contracted future revenue. Rapid customer growth and bigger deals show AIP is entering a viral expansion phase. Is the core engine behind Palantir's bid to dominate enterprise AI. Beyond headline revenue growth, Palantir's financial quality is strengthening simultaneously. Adjusted operating income for 2026 is expected to reach $4.01 billion, with operating margins around 15%. Even more important, adjusted free cash flow is projected to hit $4 billion. That proves Palantir generates real, sustainable cash, not just accounting-driven growth. Strong cash flow provides a financial safety cushion for continued expansion and R&D investment. Cash flow doesn't lie. $4 billion in free cash flow means Palantir has become a highly mature profit machine. While many AI startups are still trying to survive, Palantir is figuring out how to deploy the profits it's already generating. That real cash return is the backbone of its downside resilience in volatile markets. Behind the strong results, one structural risk deserves attention. International commercial revenue grew only 8% in the fourth quarter, far below U.S. performance. Currently, 77% of Palantir's total revenue comes from the U.S. market. If domestic AI spending slows, weak international growth won't provide sufficient strategic offset. This geographic concentration is a structural vulnerability investors must keep in mind amid bullish expectation. This is Palantir's biggest weakness, is charging ahead in the US, but Europe and Asia remain sluggish. Put 8% international growth next to 115% overall guidance gap is clear. If Palantir can unlock global markets in 2026, its long-term growth ceiling stays capped in the US. Palantir currently trades at roughly 125 times forward earnings, compared to the S&P 500's average multiple near to 0x. The valuation looks extremely expensive, but here's the paradox. Palantir operates in a near blue ocean market, with limited direct competition. Its Rule of 40 and cash flow metrics far exceed typical software peers. That premium valuation is, to a large extent, supported by exceptional execution. This isn't just an earnings story, it's a pricing game driven by scarcity. Bottom line, Palantir is challenging valuation logic with almost unreal numbers. A 1 to 5x divided by E means it's walking the razor's edge, but a 127% operating metric is rare in this industry. Can execution truly justify the premium? Drop your thoughts below, like and subscribe to Stock Market Breakdown. See you next time.